discussing Tesla Q4 earnings call, the main takeaway is really there's nothing left in the business anymore to be excited about, which is tangible. So all the upside in the stock is in potentials, FSD, energy, and robots, and maybe other things. So yes, I mean, you can look at Tesla as a car company, and then you have to say, look, this stock is way overpriced. There's nothing left here. Or you can look at Tesla as a AI company, and then, of course, there's a lot of value here. Now, the problem, of course, is that Wall Street, at best, gives you maybe some value. It's not like Wall Street doesn't give you any value. Clearly, the stock is pricing in some potential. But to really make money and generate wealth in the near future here, it's just going to be difficult. This is the main conclusion. I'm going to walk through some of the highlights that I think are worth paying attention to. I'll do it very simple, positive, negative. And let's say on the positive side, we have a lot of potential. There are interesting things. We've discussed this in our sum of the parts from yesterday. There are things to be excited about. And no matter how you twist and turn it, it always comes back to the same fundamental idea. And the same fundamental idea is always that you have potential for iteration, for innovation, for rapid change. So that's a positive. I think a positive is that we could have a further cost decline and therefore just a lot more competitive situation. I think a positive is that we do have an interesting situation on the AI front. Let's say interesting, it's worth paying attention to. And then we have, in general, let's not forget some of the sort of legacy positives of Tesla, such as decarbonization of the economy. That's still there. Now, what's the negative? I think the negative is just we have stalling growth, more talk about competition. I think that was very discouraging. Musk saying things like, well, we don't want to really do an AI day because competition just copies what we do. Well, I mean, don't you have a huge advantage in data? Why is competition even a factor? And then, generally, a lot of talk about competition, a lot of talk about interest rates. That's just not very encouraging. I would say that's number one. I think another negative is this whole Musk wanting control. I don't understand what that means, quite frankly. I just don't understand. But I'm just going to maybe leave it at some, it's just one of those things that he's farting. So, excuse my French, but maybe we shouldn't pay too much attention because there's no way he can get control just like that, right? This is not even a dual share structure. What does that even mean? So I'm not quite sure what that means. But what else is negative? I think that's it. I don't think, the fact that they're not growing now is certainly not, it's concerning, but you could have a scenario where this company gets to, 5, 6, 7 million cars. It's doable. They could have a profitable business because they're innovating on the manufacturing side. Let's not forget this company has been innovating across the board all the time. There's no reason to believe that that's not going to continue. So on that front, we're not. Again, you can say, well, I mean, look, I don't care how much you're innovating, how are you going to monetize it, but you have to also give them some benefit of the doubt and believe that once they innovate, once they bring new products to market, once costs are in control, the profitability will come. Musk, for example, said we could be the most valuable company. He used to say we could be as valuable as the most two valuable together. I mean, he's kind of backtracking from there, but that's okay. Those are semantics. What we're talking about is 3 to 5x, good performance, 20, 25% returns. That kind of thing is still in the cards. So this is another one podcast. It's January 25th, 2024. This is Krim Telko. We are down probably about 6% now with the earnings call in the books. For the year, we're down 17.8%. Markets up 1.2. We're on the phone by 19%. Clearly, it's all coming from Tesla. I'm going to focus on Tesla now, and I'm going to defer the discussion of what we're going to do with the stock because it's not clear, to be honest. But let's not talk about this. Let's just focus on the earnings call. So, like I said, positive, negative. Let's start with the positive side of things. So we have several businesses here that have potential to be monetized. Once the car business, which is being monetized, which is driving the stock and the valuation, and there is more to come here. We have next-gen platform. We have not just next-gen platform. I want to emphasize the fact that it's also next-gen production platform, which is exciting, okay? Because the next-gen production platform hopefully will bring also a more, maybe a different relationship with cost also. So we could see a more thorough transition of Tesla into what Pierre Farragut calls a microelectronics company. So that's definitely in the cards. In other words, we could see a car for 25, let's say, costing $30,000 that really has a value of $50,000. So if they continue, that's what they did with the 3 and the Y. That's why they're the best-selling cars in the world. And I think there's a potential to do that also with a lower cost. But for that, you have to change the production. You have to change the machine that builds the machine. So this is very exciting. I think second, what's positive is the advancements of FSD. I think we've been doing a lot of work here on that front, and I think it's fair to say that this is expected to continue. I mean, there's no reason not to believe that we have continuous improvement FSD, particularly now that's, whatever end-to-end really means in the Tesla context. It's something where we have photons in, controls out. So we have a integrated optimization of the, stack, not just sort of this task-specific optimization. So we could get faster iteration, we could get faster improvements, we could get faster adoption, things along those lines. That's definitely a positive. I think another very positive thing is, of course, the potential for robotics. It's a little bit further out, but it's there because I think we shouldn't underestimate it. Yes, it's maybe a long shot in many ways, but it's not the kind of long shot that you have to really believe in sort of Godot, because what I mean with that is it's tangible. It's there. You can see the potential because, I mean, that's part of the work that I've done in the last 6 months. Like, I understand what's required for humanoid robots, and I can see how transfer learning is happening from the car to the robot. There's certainly some things that have been done. Let's say, for example, all the hardware innovation that is necessary. I think that's been clear in all my seminars at Stanford that hardware is just not ready. So Tesla has demonstrated recently that their hardware is at least to a level ready to a point where now the AI can help. Where the AI can sort of do the heavy lifting now and create utility, like Drew Balino said, or somebody said on the call. The thing now is, okay, how do we make these things useful? Utility. Where's the utility? I would say that's upside. Okay, that's upside. I think the energy business, it's sort of the cousin that we never talk about, but it's huge. It's important. Growth rates are high. It's going to add to profitability, and that's great. Let's leave it at that. Let's not. What's negative about this situation? Well, the negative is definitely the disappointing growth rate in 3 and Y. We would have expected this to grow faster. They said many times that they are competing with the rest of the car market and not just with electric cars. So why isn't we have what, 2% market share globally, and why can't we grow faster? Why is there, why is this stalling? And the reason it's stalling is because I guess the market's a lot more segmented than we thought, and people are just not ready to just all keep flocking into these types of products, and that's disappointing. I think it warrants a little bit more understanding of why that's the case. Why are people buying? I'm in Switzerland right now, and people are driving around with gasoline-powered BMWs and all that kind of stuff. And quite frankly, I don't understand. But they are. Some of the feedback from the Cybertruck, let's say range and charging times. Look, I mean, you can argue to the gazoo now whether the charging times are a problem. I've been a Tesla owner for 3 years. I have rarely had a problem with charging, but I live in California. Maybe that's a different, but I don't know. My brother has an electric car here in Switzerland. It's not a Tesla. Claims that charging isn't much of an issue. Plus, if you have access to the Tesla supercharger network, I just don't see it as an issue. So it's kind of hard to understand. People are pushing them to do advertising, and it's worked for Netflix. Netflix has done a few things that have reinvigorated the business. So maybe that's something Tesla could be contemplating, more targeted informationizing, maybe not advertising, but having people understand, okay, this is the situation, this is what you get if you buy our vehicles, those sort of things. I think it's just disappointing. We thought that we have a product that sells itself, and it looks like when you hit a certain market share, there's some natural law. Even Apple has to advertise, even though Apple computers and Apple products should be selling themselves by themselves, but it seems like they're not. So there's some hiccups. Maybe it's the political situation that Musk's involved in. There's a lot of reasons why maybe we have a situation here. That's a negative. And but what's even more important is really now, of course, when you look at the stock, you have to think, why am I invested in this, right? Some of the parts we have adjusted. Some of the parts we're at $400 now. I think we went down by like 6-7%, which is fine. That's, of course, who cares about our price target? But like I said yesterday in the SOP episode, this is not about exact numbers. This is more about the thought process. We believe that it's fair to have some exposure to robotics. It's fair to have some exposure to AI. It's fair to have some exposure to compute. All these things are there. But then you have to ask yourself, how much of that do you want? And maybe you can have a better exposure with other companies. This is really the fundamental question we have to answer to ourselves. Do we want to be fully concentrated in this stock, or maybe change a little bit? Because when we invest in AI, well, then maybe we should have other things also, because it's not the only AI company. And by the way, it's the one AI company that isn't even monetizing any of the AI or most of the AI yet. So why are we fully invested in this? We were invested in decarbonizing the economy. We invested in electric cars and new car manufacturing technology, and that's still the case. But the growth is stalling now, so maybe we should reconsider our investment too. I mean, this is what the thought process is, and the reason you would want to stick around here is if you just believed that the growth rates and the returns are going to be off the charts, and they're not right now. And now you have to make a decision whether this is a hiccup or a long structural problem. This is really where we stand. I would say that's the biggest negative that we have to deal with. And I'm not ready to make a conclusion yet. My gut's telling me to change, to maybe diversify a bit, not because I have a strong opinion about either whether Tesla is still a good investment or not, or whether other companies are. It's more like I can't get excited about what they said on the call. Now, to be fair, I can't get excited about what they said on the call, but I'm very excited about the businesses. I mean, I'm curious about the next gen platform. I'm curious about their progress in FSD. I'm curious about how the humanoid robots will evolve. I'm curious about all these things. So that's still there. And honestly, quite frankly, I'm not too curious about what Broadcom or Microsoft or ASML are doing, which are sort of the companies that have been profiting handsomely from this surge in AI. So there we are. So this is, as a conclusion, the call is really a sober thing. I couldn't sleep all night yesterday. I mean, I'm in Europe, so it's time difference and stuff. But I'm really not too excited about the situation where we are right now. We are fully concentrated in Tesla. Tesla is selling off. We're losing money. It's a situation where we can probably stick around and wait. But if I'm right and the way things go also for the business, it's going to cost us. Our investors will not want to stick around. This is definitely a gigantic leap of faith you have to take, particularly at these valuations, right? We're looking at I don't know, 60 to 70 times earnings type stock, right? So in that sense, you could say, well, what are you talking about? Well, of course, all this potential is already priced. Well, not really, right? Because you can actually price the car business at a pretty decent valuation, because there's also repeat customers, there is upsell, there is software selling into I mean, you have a lot of, once you have a base of 2 million cars per annum to be sold, there's some value there, but maybe it's not 6 times sales, maybe it's only 3 times sales. So let's say the stock, in our SOP, the car business is worth around $140 a share, which I think is a fair price. So that's kind of where we see it, which will put it at sort of a 40 time PE maybe, and that's fair. I think that's about right. So all the rest is upside, and yeah, I mean, it's fine. I think it's okay to stay in the stock, but maybe not at this concentration. This is kind of the way we see it. I'm going to have to discuss, and of course we'll announce any changes to our positioning. The purpose of this podcast is to give people a sense of what it feels like to run a hedge fund, and now we're at a crossroads here where we really are thinking very hard about a story that has been with us for almost half a decade now. And the disappointing part right now is there's 2 factors that we believe, okay, there's 3 factors that make this company the most valuable company in the world. One is that they can use compute, in particular AI, to drive adoption of their cars and increase the miles driven and decrease the cost per mile dramatically. So a massive decrease in cost per mile, which is driven by a decrease in cost, which they're doing, of course, but also just increase in miles driven. So not just that they're able to reduce the cost per car, but they're able to make the car a lot more resilient, therefore it can drive more. And because it has AI assisted driving, or maybe at some point full self-driving, it can drive a lot more. So that's one driving factor that we always thought is going to be, that's what should be driving this company into the future. The second thing that we were sort of thinking is that this company will also be able to reach software margins at some point, because it's a software company. And the third point is that the company will be able to change the manufacturing process a lot more dramatically than it has so far. In other words, they're building robots to build robots. Those are the three main factors that have given us confidence in Tesla, and that is still there. But of course, the question marks are much larger, because it's not on top of investors' head, right? So you can stay in the stock with those three fundamental drivers as a reason why you're in there. Dramatic lowering cost per mile, software margins, robot that builds the robot. If that's the case, those are the three questions we're going to ask the IR. And if the answer is positive, I think we should stay in the stock. And if not, we should reduce at least our position. I think this is probably the simplest way to look at this situation. Again, to summarize all the conversation about the earnings call, in our opinion, is not really key in making a decision about this investment. The three factors that make us invested is lowering cost per mile, software margins, and a new manufacturing technology, robot that builds the robot. Thank you.